Joining us right now from our Washington bureau is Vince Reinhart. He's resident scholar at the American Enterprise Institute and a former director of monetary affairs on the Federal Reserve Board of Governors. His history really with the Fed for many years, going back to the early 80s. Still with us is our own Lizzie O'Leary. She's up on Capitol Hill. We are also joined right here in studio by our economics editor, Mike McKee. So, Vince, let me kick it out to you. So, you know, what really kind of struck me is the Fed chairman over and over really defending the point that it's not just the Fed's responsibility to oversee those very, very large institutions, but they really need to see all of the financial institutions, have oversight of them all. Does that make sense in your view?
So I think the fundamental issue is, does the Federal Reserve need bank supervision to be a better monetary policy maker? I think the answer is no. Why? Because they always have the payment system. The Fed is a critical actor in facilitating funds and clearing the government securities. And that's how they get their window into market activity and big institutions. Second, they can protect the risks associated with their lending by the type of collateral they take. The bottom line is, you look at FOMC transcripts, you look at the record, there really isn't much evidence that bank supervision materially made for better monetary policy decisions. So if you have supervision, what you have is a reputational risk. You take hits on your credibility for failures on supervision, and it doesn't help you on monetary policy.
Interesting, Vince, if they did adopt the Dodd plan, which would give the Fed only the 35 largest bank holding companies, St. Louis and Kansas City would have nothing to do. This would be a major restructuring of the Federal Reserve System. Is it worth that?
I think there's some real risks associated with it. Among other things, as you noted, Mike, there are a lot of people who are currently doing work that's no longer needed in the Federal Reserve System. Meanwhile, they'll have new responsibilities with regard to more supervision of the big ones and potentially consumer affairs. The people who do the one thing now can't easily shift into the other. So one reason that Chairman Bernanke is pushing back so hard is it'll be difficult for the Federal Reserve to absorb those changes. Another thing about the Dodd legislation to remember is it really increases the political touch on the institution. How come? Because there are going to be 3 more presidential appointments, Senate confirmation positions. That is the vice chairman for supervision, the director of consumer affairs, and the president of the New York Fed. That means they're going to have hearings just about all the time, confirming some member or other of the board.
Vince, this is Lizzie stepping in. I want to point out this is the most muscular tone I have heard from Chairman Bernanke after watching him testify on the Hill a lot. He certainly went after several aspects of the Dodd plan. What do you attribute that to?
Because right now he's torn between 2 chambers of the Congress. The interests of the Federal Reserve, in his view, align better with what's currently on the table from the House Financial Services Committee. And he'd like to push back against the Dodd legislation. Essentially, I think they view this as the opening gambit in a set of negotiations. Is the limit going to be $50 billion? Should it be $25 billion? Could somebody push back and make it $100 billion? Until the Congress passes the legislation, they're going to view this as an open issue. Also remember that we might not get any legislation at all. Chairman Bernanke wants to show forcefully, muscularly, that he is defending the people who work for him, so that if it does come to have to shrink the Fed, he can say he tried, and if in the end none of this happens, he can say we were successful.
All right, we're going to leave it there. Hey, Vince, thank you so much. Vince Reinhart, resident scholar over at the American Enterprise Institute.